What's up, everybody? It's your boy Satt coming to you with today's stock pick, news, and indicator help. No face, just facts in 5. I do the research so you don't have to. Make sure you check out the new Stocks by Satt 06 live stream, where we keep a live feed running on some of the top stocks and indices in the market, plus a stock of the week. This week's stock of the week is SpaceX. Shout out to 11 Labs for making every video possible. Link in the description and profile. Let's dive in. Today we're talking about a big picture question every investor should be asking right now. Are we in the middle of a market cycle? Because this market still feels strong, but it also feels different. AI, semiconductors, mega cap tech, and growth stocks have carried a lot of the move. But now, investors are starting to ask harder questions about valuation, rotation, breadth, and whether this rally is still early or starting to mature. I'm not here to call a top, and I'm not saying the bull market is over. I'm saying smart investors need to understand what kind of market they are in. First, what is a market cycle? A market cycle is the pattern markets move through over time. You usually have expansion, where the economy grows, earnings improve, and confidence rises. Then comes the peak, where optimism runs high, prices may get stretched, and risk starts building. Then comes slowdown, where growth weakens, earnings pressure rises, and investors become more defensive. Then eventually, recovery begins, confidence returns, and the cycle starts again. The key idea is simple. Markets do not move in straight lines forever. Different phases reward different behavior. Now, here's why this matters right now. For a while, this market has been powered heavily by AI-related names, mega cap tech, and semiconductor momentum. That does not mean the rally is fake, but it does mean investors need to watch whether the move is broadening or becoming too dependent on a small group of leaders. When only a few stocks carry the market, that can work for a while, but it also makes the market more fragile. When leadership starts rotating into other areas, that can be healthy, but it can also mean the easy part of the move is behind us. So what does a mid-cycle market usually look like? In a mid-cycle environment, economic growth is still holding up. Earnings still matter a lot. Leadership starts to broaden beyond the first group of winners, and pullbacks become more normal. That last part matters. A mid-cycle market can still be bullish, but it usually feels less smooth than the early part of a rally. Some sectors keep leading, some cool off, and others rotate into favor. That is why the market can feel strong, but harder to trade. It may not be panic mode. It may just be a more selective market. But we also need to respect the warning signs. Late cycle warning signs show up when valuations get stretched, speculation gets overheated, market breadth starts weakening, and defensive sectors gain attention. In plain English, that means prices may be running faster than fundamentals, people may start chasing hype instead of earnings, fewer stocks may be participating, and investors may begin rotating towards safety. None of that automatically means a crash is coming, but it does mean risk management matters. So what am I watching next? First, market breadth. Are more stocks participating, or are just a few giants carrying the move? Second, interest rates. Rates impact valuations, liquidity, borrowing costs, and risk appetite. Third, semiconductor leadership. Chips have been one of the biggest engines behind the AI trade. So if semis stay strong, growth leadership still has power. Fourth, small cap participation. If small caps show real strength, that could signal broader confidence beyond mega cap names. Those 4 areas can help tell us whether this market is healthy, tired, or rotating. Now let's talk about how investors should respond. First, do not overreact. A mid-cycle market does not mean sell everything and run. Second, do not blindly chase. Just because something ran hard does not mean it is still the best opportunity. Third, stay disciplined. Know your risk, manage position sizes, and do not let emotions make decisions for you. Fourth, keep your investing process tight. Look for quality, earning strength, strong trends, and reasonable setups. Respect momentum, but do not worship hype. Here's Satt's take. To me, this market feels more mid-cycle than early cycle. I'm not calling a top, and I'm not saying the bull market is over. I'm saying the market may be maturing. And when markets mature, investors need more discipline, better selection, and less emotional chasing. I give this an 8 out of 10 market lesson because understanding the cycle can keep you from making beginner mistakes. The best investors are not the ones who pretend they can predict every move. The best investors understand the environment, manage risk, stay flexible, and let the market confirm the story. Remember, I'm not a financial advisor, and this is not financial advice. Do your own research, manage your own risk, and never invest what you can't lose. Don't forget to smash that like button, subscribe, and drop a comment with a stock or indicator you'd like me to cover next. This is Satt, and I'll catch y'all in the next one. Peace.